Actually, I learned about it in the academy, and I quit the full-time force in 2000 when I started the Online Trading Expo. So maybe a few of you have been to the Online Trading Expo. Got another one coming up next weekend now in New York City. Thankfully, we missed the storm by a week. But I'm still a reserve officer, which means I'm still a cop in LA. In fact, I'm going to work a 12-hour shift. Right after I'm done with this, I'm jumping out of here and going up to LA and see if we can't find that bad guy that's on the loose out there. So I still work a shift in a black and white with a partner about every other week just to have a relaxing time away from trading. And honestly, it truly is a relaxing time. After trading all day, going and chase bad guys is kind of different because I have to take my mind off of trading and take my mind and put it completely on my tactics in the patrol. So let's see. Let's start. Here's what I've been doing. I've been doing over the past few years at traderinterviews.com. I've been talking to a bunch of wealthy traders, and I put together a list a while back of things that I hear the wealthiest traders say over and over again. After you talk to a lot of traders, you find out that a lot of them start to say similar things, and I started to make notes of these things that people are saying to me over and over again. Because when I hear them over and over again, and these guys are making huge amounts of money, I pay attention to that because if they're doing it, that's probably something that I need to be aware of as well. Now, some of these things are going to be obvious to you. I try to stay away from the whole make sure you set your stops and keep them and all that stuff. I try to put together a list that's a little bit different than that, although some of them will be familiar to you, obvious to you. And I'm hoping that if you get one or two things out of these habits that make sense to you, that you add to your own trading, then I'll have been successful here. So some of them may be obvious. Other ones you'd be like, wow, you know what? I never really thought of it that way before. And so hopefully that you'll do that. So let's just jump right into this, and let's talk about these 20 habits. Actually, I think there's 30 here. Number one, wealthy traders are patient with winning trades and enormously impatient with losing trades. And if you think about this, the vast majority of newer traders, I know I was, do exactly the opposite of this. This is straight out of the mouth of Dennis Gartman. Dennis is a trader, a hedge fund manager, and you'll see him on CNBC occasionally. But wealthy traders flip that on its head. What you do when you normally start trading is you get into a trade and it starts to go against you and you think, you know what, I'm going to let this go just a little bit longer. I'm going to be patient with this. I know I'm right about this. And when things are starting to go in your favor and you're making money, you immediately start going, you know what, ooh, I better get out of this. I better bring my stop up to break even. I better be impatient. I don't want this to turn into a loss. Wealthy traders do exactly the opposite of that. They are extremely patient with their winners. They let their winners run, but it's more than that. They're patient with them. They don't get freaked out when things it upticks and then it ticks down a little bit and then goes back up again. They're patient with their winners, enormously impatient with their losers. Most traders do the exact opposite, and that's why most traders lose money. If all you do is this, patient with winners, impatient with losers, you're way ahead of the game. Number two, wealthy traders realize that making money is more important than being right. We all want to be right about our trading. We all want to be right about our decisions. Like, I'm a good decision maker. I'm going to be right in this market. You can try to force your thoughts and force your opinions of being right on the market all day long, and they will just spank you every single time. So that's how they can be impatient with their losers and patient with their winners. They're not trying to be right. They're not trying to make a right decision. They're trying to make money in the markets. So if you get spanked in the market yourself 5 times in a row, and that frustrates you because, darn it, I know I'm right about this. I'm stopped out, and my trade immediately goes in the direction I thought it was going to be. Try to settle down, be calm with that. It's not about being right in the market. It's about making money. And if that means you're doing something wrong, and you can't let your ego get in the way and not flip-flop that right away. Your job is to make money. So you need to be on whatever side the market says you need to be on. Don't you tell the market what side to be on. Let the market tell you to be what side to be on. There's another couple of slides here that are going to kind of build on that. So, and let me just stop here and say that I'm still perfecting this presentation in terms of understanding the 20 things that traders do that are very good in this market. Some of them I'm really good at explaining. Some of them I'm not very good at explaining, but I'm getting better. So slide number 17 has always been a problem for me. We'll get there, and I'll try to explain it as best I can. Number 3, wealthy traders look at technical analysis as a picture of where traders are lining up to buy and sell. Most of us look at charts and we say, here's a support area, here's a resistance area, which is technically correct. But what does that really mean? Why is it support and resistance? It's not just because that's a line on the chart and that's where it says it's supposed to be. Wealthy traders don't see it as support and resistance. They see it as there are traders lining up to buy here and there are traders lining up to sell right here. They almost look at a chart and they see people. They see emotions. They see, okay, I know that there are a lot of traders lining up and got their stops right here. Why do you think you get stopped out all the time and then your trade immediately flips around and goes the other way? Why do you think that is? It's not because they know that you're in the market. They know that there's a bunch of you in the market right there, and the professional traders see you there, and they go down and wipe you out and then turn it around and bring it right back up. That's exactly what's happening. You need to start looking at the charts at places where traders are lining up to buy and sell. That's the reason something is support and resistance, not just because it's a price level here and it hasn't risen above that price level. It's because everybody's looking at that price level. So wealthy traders look at it as, here's where the people that I'm going to take my money from today are sitting. That's exactly it. It's not pleasant to think about that, really, but if you start thinking that same way, you can be on the same side as those traders. Number 4, before they enter any trade, they know exactly where they will exit for either a gain or a loss. You should know exactly where you're going to get in and get out before you enter the trade. I don't know of any wealthy trader that doesn't know where their stop is going to be or where they may exit a position, and they don't know generally where the level is where they're going to exit on as a profit as well. They know both of those levels. If you don't have one of those pieces of information before you hit the buy button, stop. You need to know. Even if it's just a profit target because you're buying a 52-week high and it hasn't been above this level in a long time, have a general idea of where you're going to exit either way. That way there's no question and there's no disagreement in your own mind about where that's going to happen down the road, okay? Know that it is what those numbers are before you get into a trade. Wealthy traders do. And by the way, if you can't see the slides for some reason, this will be recorded and you can see that presentation anytime. So you will get this, don't worry about that. But I don't show any charts in my presentation. Well, I show one, but it's as an example. So even if you have just the audio, you'll be good to go. Number 5, they approach trade number 5 with the exact same mindset they did on the 4 previous losing trades. This goes back to having confidence in your system. It's not blind confidence in that I'm just going to trade my system no matter what. If I lose 60 times in a row, man, I know my system's right and I'm going to keep trading it. No. But statistically, it's very possible for most trading systems and most even discretionary ideas to be wrong 4 times in a row. It is absolutely statistically relevant for that to happen. The trouble is that most of us, after we have those 4 losing trades in a row, we get that 5th signal and we see that 5th setup that we know matches our criteria. And what do? Ooh, you know what? I've got the 4 last trades I've lost on. I think I'm going to sit this 5th trade out. And what happens? That 5th trade inevitably is the most beautiful trade of the day, works its way, would have wiped out the losses of all the 4 previous trades, plus makes you a couple grand, on that next trade. So unless something has changed in the market, unless the market is telling you that something has changed and you need to reevaluate your ideas, take that 5th trade with as much gusto and enthusiasm as you had the first 4 trades that you lost on, okay? Now, this is, again, not being blind about it. It's just a matter of making sure that you understand that there will be times when you lose 4 times in a row, and as long as you keep your stops tight and those stops are matched with your level of risk tolerance, and you're not risking more than you're supposed to based on your trading plan, which everybody should have, take that 5th trade. The wealthy traders do, because the 5th trade, of course, is always the one that works out when we don't take it, right? That's just the nature of the markets. Number 6, they use naked charts and focus on zones. So let me go to this next slide. It's my only chart, and it's not really a chart. When I first started trading, we all do this. I put on arcs, Fibonacci, support and resistance, median lines, pitchforks. I can barely see the damn price bars anymore. I don't even know where this is. This is, I think on the right there's a red bar over there. The trouble is that the more information you put on a chart, the more difficult it is to find confirmation of anything. Most traders go through this evolution where they start with a plain chart, they start adding something on top of that, something on top of that. Pretty soon your chart looks like this, with a whole bunch of gobbledygook that you can't even see price anymore. And price is what matters. So eventually they start peeling stuff off. They peel off the Fibonacci, they peel off the median lines, and they have one thing. And they watch that one thing for a while. And then they realize, you know what, here's something that's working for me. Let's just use that one thing. So all of the wealthy traders I've talked to, almost to a T, they look at price and volume. That is it, price and volume. They may look at price and volume at different price levels, like how many trades came in at this price, how many trades at this price. So they may use one other thing. They might throw a moving average on there just to get an idea of, whoa, there we go, thank you. They might throw a moving average on there just to see an idea of where price has been and where it's going. But understand that you got to start peeling things off and just looking at price and price levels. That's really what's important. So, and they don't think of the Fibonacci, the 618. How often have you seen something bounce off a 618 to a tick? Very rarely. Sometimes it'll come just shy of the line coming up. Sometimes it'll go past the line and then back down if you're looking at a resistance level. They don't see the 618 need to be around the 618. Okay, I would love it if it always hit it to the tick and then reversed immediately. That's just not the way it happens. So, and you can't see that unless you've got a clear picture of where price is. So use naked charts, pull things off, test things one at a time. If you put 5 things on there and you have to wait for all 5 things to happen, you'll take one trade a year, and even then it may not be the right kind of trade. Number 7, they realized a long time ago that being uncomfortable trading is okay. We all want to get to this point where we sit down in our chair at our desk and we feel awesome about our trading. We know what we're doing. We've studied every method there is. We know all the technical analysis. We've studied all the courses. We've read all the books, and we feel like now I'm going to be totally comfortable. I'm going to make money on a consistent basis. We all work toward that. But the funny thing is that I talked to a lot of wealthy traders who said, look, when I sit down in my chair in the morning to go look at the market, I'm a little uneasy. I feel a little uneasy about every piece or every trade I take. I thought at some point I would get to a point where I would be totally confident and at ease trading. It never came. So what you have to do is understand that you have to be okay being uncomfortable. It's okay to be sitting in your trading chair and being uncomfortable placing those trades. But you have to be able to make good decisions in spite of being uncomfortable. There is a good video. If you sign up for my free mailing list at traderinterviews.com, little subtle pitch there. There's a good video that I call it's the best video about trading that's not about trading. And it's about Evan Longoria of the Tampa Bay Rays talking about how he is still uncomfortable. This guy is an all-star and a batting champion, is still uncomfortable every time he steps up to the plate. That there's this level of uneasiness that he thought he would get to the point where he could step up and go, okay, bring it, and just take a swing and be okay with that. He's uncomfortable at the plate all the time, but he's able to make good decisions about which balls to swing at in spite of that uncomfortableness. So being comfortable, being uncomfortable. Wealthy traders do it. Number 8, the markets they trade fit their personality. They are a participant, not an onlooker. So this is a little more of a nebulous one. I'll try to explain it as best I can. We all hear about, well, I need to be trading the market that kind of fits my personality as a person. I don't want to trade something that goes too quickly if I'm more of a slower, introverted trader. So that's true, but it's more than that. After a while, wealthy traders don't feel like they're just an onlooker trying to get some scraps out of the market while the big boys are out there doing their thing. I think we all feel like that, like I'm not really knowing what I'm doing here. I'm kind of playing in somebody else's playground. Wealthy traders after a certain point feel like this is my backyard. This is what I do. And I feel like I am a market participant as much as anybody huge hedge fund trader out there. I am as much of a player in this market as anybody else. So you've got to get to the point where you feel like you're not an onlooker just trying to make some money here. You feel confident enough that you are a participant in this market as much as a market maker or a floor trader as anybody else, that you belong here. I know that's a little touchy-feeling nebulous, but it's something I hear a lot from the traders that I talk to. Number 9, they stopped trying to pick tops and bottoms long ago and stopped losing money. Now, I get a lot of feedback on these 20 habits, and sometimes it's negative feedback. And I get a lot of negative feedback about this one. I get somebody who will email me inevitably after every presentation and say, look, I make all my money picking the tops and bottoms. And I've interviewed traders that do that. The trouble is that is a really tough skill to do. And the way that what I tell people is, look at any chart. Pick up and pull up a chart, a 6-month chart, a daily chart, whatever you want to pick, and draw lines on the where price turns. Where price turns, if you draw a line to the left of it, to the right of it. And you'll see that 80% of the chart is where something is trending. It's not turning. So they stop trying to pick out the 20% of the chart to make money on and start looking at the 80% of the chart where it's not turning and make money there. Picking a top and bottom is really hard, very hard to do. I've seen traders that can do it. I can't do it. And most traders I talk to can't do it. So they try to get the meat of the move, okay? So stop trying to pick your tops and bottoms. Get the meat of the move between those things, and you're in a much better position to make money. The kind of corollary to this that I tell people, when somebody emails me and they say, Tim, look, I've listened to a bunch of the interviews. I still can't make money. I can't replicate this. I'm trying all kinds of things. I'm having a tough time making money consistently. And all I tell them is, look, what I've told people that seems to work and what I do for myself when I'm having a really tough time, all I do is I buy 52-week highs and I sell 52-week lows. That's it. That's my strategy. Most people think, well, why are you doing that? You're buying at the top and selling at the low. Well, guess what? There's a reason those have gotten to those places, and they're likely to continue in that direction. Are you wrong still? Of course you're still wrong on some of those trades. But if you're having a tough time making money and all you do is buy 52-week highs and sell 52-week lows, I guarantee you you're going to see some success. Okay? Because what you're doing is you're buying into an existing trend. You're not trying to pick the top or the bottom. Number 10, they stopped thinking about the market being cheap or expensive. I want you to eliminate the words cheap and expensive from your trading. Nothing is cheap and nothing is expensive. That 25-cent option that you can buy 1,000 contracts of because it's a week out and it's out of the money, but you think it might make some money because the maximum loss is 25 cents. If it goes to zero, is that more expensive than Google that goes up 25 cents at 650 or 700 or 710? Wealthy traders don't think of the market as cheap or inexpensive. Okay? Apple is not cheap or expensive right now. What is it? Still at $400 some dollars. 462, whatever it is. Is $500 oil expensive? Not if somebody's willing to pay $5.05 10 minutes from now. Is a 25-cent option cheap? Not if it's at 15 cents an hour from now. All wealthy traders think about is somebody going to pay more or less for this in an hour, in a day, in a month? That's all they care about. It's not about being cheap or expensive. We don't know all that's involved in the pricing of what goes into that. But is somebody willing to pay more or less for it later? That's all that matters. Okay, so no more cheap or expensive. I want you to think of it as payment. Who's going to pay more for this? Who's going to pay less for this in an hour, in a day, whatever your time frame may be? Number 11, they are willing to change sides, short to long, and vice versa when the markets tell them to do so. This is about not being right. They don't care about being right. If they get up with a bias in the morning that things are going to be a long day, that they're going to be going long, and the market starts to tank, they will flip sides. They will flip sides in that war in a heartbeat. They are not on anybody's side. They are on the side of making money. And if that means their initial bias was wrong, they will flip-flop in a heartbeat, and it may have no qualms about it. So be willing to do and trade in the way that the market tells you, not that the way you think it should be. You can be wrong all day long. We've all heard that old adage, the market can be wrong longer than you can stay solvent. And that is so true. It will prove you wrong day after day after day. It tells you what to trade, not the other way around. Turn my cell phone off here. All right. Number 12. They trade aggressively when trading well and modestly when they are not. Most traders, I'm afraid to say, do the exact opposite. When they have a couple of losing trades in a row, they double their size to try and make it up. And when they're winning, they take back. They're afraid to put on size because they don't want to have that profit turn into a loss. I can tell you right now that wealthy traders, when they are trading well, they can pile on size faster. I mean, they pile on enormous size that would make me just my gut wrench. But when they're trading well and they're viewing the market well, that's the time to make their money. That's the time to really get in there. When they're not trading well and they've had a couple of bad days, they pull back. What I've always done, my rule always was, if I had 5 losing trades in a row, I can only trade a single share until I'm right. That's it. Are you going to get killed on commissions? Absolutely. But I'd rather pay a $12 commission or a $6 commission and get into the mode of the market and trade a single share until I can make money price-wise on that single share twice in a row. Then I can get back and put on my regular size, 100 shares, 500 shares, 1,000 shares. If you are trading badly, trade a single share until you can trade well again. And yes, you're not going to make any money because you're not going to get, make over more than what the commission is. But the commission is your education. Don't let the huge loss be your education. Okay? It's cheap education. Trade aggressively when you're trading well and back off when you're not. 13, they realize the market will be open again tomorrow. I kicked myself in the butt for like months when I missed that Netflix short. I thought that thing was going to turn around and it went down like $150 and I never caught it. And I was like, God, I'm never going to get a chance to trade Netflix again when it goes down that much. It may not be Netflix, but you are going to get another chance. I promise you another opportunity is coming. The market will be open again tomorrow. And it's hilarious. When I talk to traders, they get down on themselves more for missing a trade than for a losing trade. How crazy is that? And I've done it too. I'm more angry about the trade I missed than the trade that I lost 10% on. That's nuts. You should be happy going flat if the alternative is losing 10 or 20%, right? The markets will be open again tomorrow. You will have another opportunity. I promise you. Don't worry about it. Number 14. They never add to a losing trade, ever. Now, I get some bad feedback about this too. Inevitably, we'll get somebody who will email me after this presentation. They say, Tim, I hear what you're saying, but I got this great martingale strategy where I just double down every time I lose. You will get slaughtered eventually. You may not happen today. It may not happen tomorrow, next month. You will lose your entire account. You will blow up doing that. If all you do is number 14, never add to a losing trade, ever. Yeah, but Tim, nope. Now, I'm gonna preface this with one caveat, and it makes me really nervous to do it because it gives you an excuse. Okay, the only time a wealthy trader, a big trader, would do this is if they need to get into a size big, 50,000, 100,000 shares. They can't do it in one trade. They have to go in. So after that first trade goes in, it may tick down a bit. If it hasn't reached the level, like it's still in the price zone that they want to buy within, they will add to that position even though it has gone against them from that first trade. For 99.9% of us, we'll never have to worry about that. So if all you do is just never add to a losing trade, I promise you'll be in this game a lot longer, and it will give you time to figure out what works before you blow up your account. Don't ever add to a losing trade. Just don't do it no matter what. 15, cash is the target, but they set goals for their trading that are anything but money. What does that mean? When I talk to a lot of wealthy traders, they say, you know what? I ask them all the time, how much money do you make? And I hope they don't hang up on me. Most of them don't. But they say, well, here's how much money I want to make, but that's not my goal every day. Look, we're all in here to make money. Let's not kid ourselves. We're here to make money, a lot of money, be rich, buy the big house, buy the car we want, have the lifestyle we want, the freedom we want. That's why I'm here, man. I'm not here to trade for trading's sake. I'm here to make cash. But the problem with that is if you make cash, the end-all be-all goal of your trading, that goal is going to cloud your judgment. If your goal is to make 500 bucks a day, you're going to overtrade when you're trying to make that when you shouldn't be trading. You're going to make decisions you should not be making in order to get that goal. So what you do instead is, and what most of the wealthy traders I've talked to have done is said, look, I have a trading plan, and my goal is to follow that and not be stupid and make bad decisions. That's my goal, is to follow my trading plan to a T, to not make bad decisions. And because I make that the goal, the money will come. But I can't focus on money, because if I focus on money, I look at the P&L constantly and I will overtrade to try and fix it. If my goal is 500 a day and I made 300 yesterday, I'm going to overtrade to try and make 700 tomorrow. So that money clouds the judgment. You got to make your goal some other thing that inevitably, if you do that, the money comes. That's what you got to be doing, and that's what wealthy traders do. Number 16, they read trading books, but they read more crowd books too, and I put 3 of them up there for you. The Wisdom of Crowds by James Surowiecki, very good one. The Art of Strategy is one I finished recently. That's really good as well. And Markets, Mobs, and Mayhem. Why do they read about that? Why do good traders and wealthy traders read about rioting and mobs and mayhem? It's because that's what the markets are. The market is just basically a controlled riot, and sometimes not so controlled. It's the psychology of people, fear and greed. You may have heard that. So if you understand the psychology of fear and greed and why that drives price, why supply and demand, which is based on fear and greed, drives price, you're in a much better position to understand why things are doing things, why price is doing something it shouldn't be doing. Why is Apple price just getting clobbered right now when they've got $100 gazillion in the bank and their products are still selling well? Okay, understanding the psychology of the markets and who's trading, us human beings in the market which drive that price, will give you better answers to that. All right, let's moving on to number 17. I actually have 10 bonus habits here too. I'm going to go through them quickly. Number 17. Oh my goodness. All right. This one is the bane of my presentation, but I'm going to try to explain it. Wealthy traders provide liquidity to the markets while watching price and volume. No, this is not the one. All right. Yes, it is. Here. There's a couple in a row here that are kind of similar. Wealthy traders, when I talked about them feeling like they're participants in the market and not onlookers, I hear wealthy traders talk about providing liquidity to the market, and I heard them more than one. I heard them I heard them saying this over and over again, and I thought, what do they mean by providing liquidity while watching price and volume? They don't see it as going long and short. They talk about providing liquidity. Here's the best way I can explain it. There's 2 ways I explain this. And I'm still working on this, guys, so forgive me, guys and girls. Forgive me for if this one is not quite there yet. I'm still working on this one. Wealthy traders think of it this way. Picture yourself going into a grocery store, and you walk into the store to get your Yoo-hoo and donuts or whatever it may be, and you see there are huge lines for 2% milk. Wow, why is there 2% milk's hot today? This is the hot, trending higher. The milk prices are going higher. Everybody's in line with 2% milk. So the normal trader will go to the back of the store into the refrigerator and buy 2 gallons of 2% milk and walk up and get in line with the rest of the people. That's not what wealthy traders do. Wealthy traders will walk up to the checkout line and walk up to the checker and say, hey, let me check out some people here with 2% milk for a while. Let me do your job for a while, and let me make a market in milk for a little bit. And they start buying and selling milk. They run the regular traders through their checkout line. They are the checker in the line rather than the customer. I know that's not great. There's something there. I'm still working on it. One more story to explain this a little bit better, okay? There is always a hot toy at Christmas time where the parents all want the hot toy for their kids. Cabbage Patch dolls, Legos, whatever it may be, whatever the hot toy of Christmas is. And when parents go out to the store and they go from store to store to store looking for the hot toy, they can't find it. They want to find it. They wait in line since 4 a.m. in the morning to go into the toy store and buy this hot toy for their kids, so they have it under the tree at Christmas morning. The trader parent doesn't do that. The trader parent says, you know what? There's money to be making a market in that toy. So they do everything they can to go out and get the toy, and they immediately put it on eBay for double and make a market in that toy rather than buying it for themselves. That's how wealthy traders think of their trading. They think of it as making a market, almost as market makers themselves. They don't think of buying it for themselves for their own portfolio to hold on to it to rise in price. They make a market in that. There's something there, folks. I'm not exactly sure what it is. I'm still working on that part of it, but there is something there. So keep that in mind. I hope that just kind of triggers you to start thinking of the market when you trade yourself. Number 18, they have a way to gauge fear, greed, and speed of transactions, and one way is a tick chart. So I always hear wealthy traders talking about how they gauge the momentum or speed of the market. And the easiest way to do this, they all have their own. I had one guy that I interviewed a year ago that actually had programmed a bell to ring, and when the market starts to move quickly, the bell rings faster. Ding, 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 almost like the opening of the stock exchange. That was his audible way to hear. Maybe it's pit noise. Pit noise starts to rise, and that's your way of understanding the volume of the market. The way I do it, I have a single tick chart that I put up in the left-hand corner of my screen that prints a bar every tick. And when the market starts to move faster, the ticks start to go faster, and the bars start to print faster. It's my visual way of kind of seeing that the market is starting to get frothy. It's starting to develop. I don't have pit noise, so this is my way of understanding the fear, the momentum of the market, that things are speeding up and slowing down. So I would suggest put a tick chart on your, it's an easy way, every software program has it. Use at least one tick chart, not to trade on, but just to get a good feel for the speed of the market. 19, they practice reading the right side of the chart, not the left. What do I mean by that? We can all see that head and shoulders that was beautiful a month ago in the Russell. We can all see that bear flag 2 weeks after it printed. Whoop-de-doo, you can see. My daughter could recognize a head and shoulders on a chart pattern when she was 5. That's not where the money's made. I can make no money on that knowing after the fact. It does me no good. The wealthy traders out there see those patterns as they are happening. And this gets into a little bit of fuzziness in terms of prediction. I'm not telling you they're fortune tellers or they're reading crystal balls. That's not it. But what they've done is they have gotten very good at reading the side of the chart that has nothing in it yet. There are no bars there yet. So what I want you to do to try to practice this a little bit is just look at the bar that has printed most recently and try in your mind to visually predict where the next bar is going to print. It's not about being a fortune teller and reading the future. It's not about that. It's about seeing those patterns as they happen. It's tough to see a bear flag in your mind unless you've practiced seeing, okay, where's this next one going to go? Where's the volume going to be? Start predicting in your mind, where is that next bar going to print? That exercise will help you get into these patterns before they happen, while they're happening, okay? Wealthy traders do it that way. Number 20, every wealthy trader has an edge. If you can't explain to me in an elevator, like I'm a 2-year-old, no, that's a little young, like a 6th grader, what your edge in the market is, you don't have one. If you can't explain it to the average person on the street what your edge is in the market, you don't have one. The only guys that may be the exception to this are the algo traders that are doing high-frequency stuff and are PhDs in computer programming. They probably can't explain their edge, and they wouldn't want to anyway because that's their IP. But for most of us, you have to be able to explain that. And it doesn't have to be anything rocket science. It can be my edge in the market, the thing that I see better than anybody else, is when the 5-period moving average crosses above the 10. That's my thing. I don't know why I can read that well. I can tell what's going to happen when that happens. It doesn't have to be complicated. It can be very simple, but you have to have an edge. It's probably not going to be moving average crossovers, okay? But it's got to be something where you feel like you have an advantage, like you see this happening, and for whatever reason it makes sense to you. So you've got to have that edge. If you don't have an edge, you're just guessing. And guessing is not a trading strategy. 21. Their position size is calculated exactly on risk tolerance. I have never heard a wealthy, successful trader tell me that my position size is 1,000 shares. I've never heard it. And in fact, when I ask wealthy traders, so what's your normal position size? There's a silence on the line. And then the next thing they say is, Tim, that's the stupidest question that anybody's asked me this month. What are you talking about? I need to know what I'm trading, what the volatility has been, how much is in my account. I need to hold, so they work backwards. What wealthy traders do is they say, okay, if I can risk 2% of my account, then I take the share price and I take 2% of the total amount of my account, and I work backwards to determine the share size down to, okay, I'm trading Apple today. I can only risk 2% on this trade. Therefore, my share size can be 306 shares. Literally, that's how they do it. There is no guessing. There is no 500 shares. Trading 500 shares of Dean Foods at DF is a whole lot different than trading 500 shares of Apple. Okay, there should be no set position size for you. You should calculate it based on your risk and work backwards. Every trade you do is going to have to be different in terms of share size. 22. Profit targets are based on average true range or something. What this means is that same thing as setting share price. You can't just say, I'm going to make $1 on this today. All right, my average profit target is $1. Well, that's fine, but if something only moves typically 50 cents in a day, how are you going to make $1 and you're a day trader? It's going to have to be based on the range of something that it normally trades. What's the normal volatility? Then you work your way backwards to figure out where maybe a price level is that you see as resistance. That's the way it's determined. You can't just say I'm going to make $1 every time or $2 on every trade. It doesn't work that way. 23. 1 or 2 trades a month make their month. This was kind of surprising to me. I thought, you know what? Traders just grind it out every day. And some do. A lot of the floor traders say, I ground out profits every day. But for most of the wealthy traders I talk to, they grind it out all right. And then when that 1 or 2 trades comes along, they pile on size like a monster. And that trade makes their month. Sometimes 1 or 2 trades make their year. Think about the patience that takes to wait for those 1 or 2 trades to come along. But that's the truth. When they come along and they're running and it does well, they pile on size like crazy and they take advantage of that sucker because they know that might be the 1 trade this month and they're going to make their account. That was surprising to me. 24. Confident decision makers in the face of incomplete information. Now this is where I think cops are good traders, and the reason for that is when I have a traffic stop and I'm in a high gang area and I know I'm stopping a gang vehicle that's wanted or that matches the description of a vehicle that was just involved in a shooting 3 minutes earlier, and I'm walking up to that car, I probably wouldn't walk up to that car, but is that driver reaching for a gun or is he reaching for a cell phone to call his girlfriend and tell her that he's going to be late because he just got pulled over? I have to make a decision based on incomplete information. Now, there was the idea that you can make good decisions even with incomplete information is a tough one, right? That's about not being comfortable all the time. I'm not always comfortable 100% out on the street because I am working with incomplete information. Do I shoot this guy because it's a gun or do I not because it's a cell phone? I've got to make that decision. So wealthy traders are comfortable. You're never going to know everything there is to know about a trade if it's going to work out. You'll never be that confident. So you've got to be able to make a decision knowing incomplete information, and you've got to be confident in doing that. 25. A losing trade is not a reflection of themselves as a trader. If you lose, it's easy to feel badly about, I'm not a good trader, I'm just not getting this, it's not working out for me. The market's not trying to put you in a bad mood. It's not a reflection of you as a person when you're having a bad day as a trader. If you're not making great decisions, if it's just not happening for you. You're going to have those days. It's not a reflection on you. Wealthy traders get past that. They step up to the plate again the next day with as much confidence as they did when they started the day before. 26. Their business isn't trading. It's finding the right trades. Full-time traders, new ones, have a tough time with this because they come from a job where you're working all day. And if you're not working, you're playing Galaga on your computer, then you're not working. Your job is not to be in trades. Your job is not to push the buy button or the sell button all day. That's not your job. Your job is to wait for the right trade to come along and then execute on it. And does that mean you sit on your hands for 5 hours until that happens? That's it. You're trading. You're still a trader if you're just sitting there flat in the market and not in. Okay? I'm getting close to my time here, so we're going to move it. Just a few more. They write down or record every trade, their price, thoughts, or mood. Okay, that's part of a trading journal. A lot of the wealthy traders I talked to right in there what they had for breakfast and how they felt when they got up and how much sleep they got the night before. Write as much down as you want, okay? You've got to keep a record of that because what traders will find out inevitably is, hey, I look back at my record, I make crappy decisions from 11 to 12. Why is that? I don't know. Maybe because I'm hungry and I'm waiting for lunch, or one life to live is on, and I like that show, and I'm watching. I'm whatever it is. I cannot make good trades between 11 and 12 p.m. Pacific. So guess what? I'm stopping trading at 11 a.m. Pacific, and I won't pick back up until noon. You can fight it and try to figure out why you're not making good trading decisions, but the other alternative is just not to trade during that hour. But you're not going to know that unless you keep really detailed notes about times and how you felt and what you were doing and the reasoning behind your trades. 28. Their conviction on an active trade remains unless something major changes. I'm a better trader when I put in a trade, put in my profit target, put in my stop loss, and literally walk away. Because if I sit there, even though nothing has changed in the market, nothing in the market has told me that I need to do something with that trade, I start to fiddle with it. I fiddle with the profit target. I fiddle with the stop loss. I think maybe I should add more to it. Maybe I should take half off. And I didn't realize this until I had to start trading and go to meetings and things like that, and I had to walk away from it. Oh, lo and behold, guess what? I'm making more money this past 3 weeks when I had to put a trade on and leave than I did sitting in front of it all day. This is where some traders are half and half. They can do it. They can sit in front of their trade all day and not fiddle with it. For me, I couldn't. I always wanted to fiddle with it. So they remain convicted, and if that means you have to walk away and just what happens, then so be it. That's the way I have to trade. 29, a winning trade does not result in taking on extra risk the next trade. Just because you had a monster trade the time before does not mean you double your size the next time, okay? If your trading plan does not account for that, you shouldn't be doing it. Every trade is set individually based on your trade plan. And 30, they trade the reaction, not the news. They don't trade the news of non-farm payrolls as much as they trade the reaction to the news. Some of the wealthy traders I've talked to trade the reaction to the reaction. Okay, so it's not so much about the news, it's about the reaction to the news. Sometimes it's the reaction to the overreaction of it. You know what I mean by that. So it's not about trading news, really. What they mean is they trade the reaction to that news. Now, those are 30 things. Some of them are more applicable to you than others. Hopefully, one or two of them made sense to you or get you to think about your trading in a little bit different way than I've done my job here. So I think everybody's had an offer today. Here's my offer. TraderInterviews.com/links/lifetime. We have a lifetime membership to our Trader Interviews that is normally $1,500. And right now we're doing it for $4.99, which is the same as a 1 year. We do a new interview every year or every month, and there's 287 interviews with wealthy traders already in there. And the idea of these interviews is not to teach you how to trade. It's to listen while you're on your way to work or listen on the way to doing whatever at the gym and going, ooh, you know what? There's something I haven't thought about. Let me think about that. If you get one idea from every interview, that's the idea. And if it makes you $500, then you've made up for it. So, all right. Let's see. If there's any questions, I can take questions. Let's see. Slides 1 and 4 seem to conflict with each other. Well, let me go back and take a look at that.